Good afternoon, everyone. My name is Venkateswaran, and I'm delighted to welcome you all to the 23rd NYU Stern Economic and Market Outlook Forum. The host of today's forum is the Stern Center for Global Economy and Business, which serves the university through outreach to the broader community, including the academic, business, and policy worlds, as well as scores of students and alumni around the world. We're pleased to have in the audience today students and faculty from all over NYU, as well as many alums. Thank you all very much for joining us. Today's session will last about 90 minutes. It will begin with a short presentation of about 10 minutes each by each of the panelists about their economic and market prospects, followed by a Q&A, the audience Q&A session. We will finish shortly before 6:30 p.m. To ask questions, please enter them through the Q&A feature in Zoom. In moderating the session, I'll try to limit repetition by grouping similar questions together and presenting them to the panelists. Let me briefly turn to introducing our very distinguished panelists. We are very honored today to have with us Jan Hatzius, who is the Chief Economist and Head of Global Investment Research at Goldman Sachs. He's a member of the firm's management committee and the firm-wide client franchise committee. He's the #1 ranked global economist in the annual Institutional Investor Global Fixed Income Research Team, a position he's held in the US and global category for over a decade now. He's also a member of the economic advisory panels at the Federal Reserve Bank of Chicago and the Congressional Budget Office. He earned a DPhil in economics from Oxford University, as well as degrees from the University of Wisconsin-Madison and the Kiel Institute for the World Economy. Welcome to NYU, Jan. Our next panelist is Michelle Meyer, who is the Chief Economist for North America at the Mastercard Economics Institute. Prior to joining Mastercard, Michelle was head of US economics at Bank of America, where her team had been ranked in the top 3 economics teams in the Institutional Investor All-America Fixed Income Research Survey, including the #1 rank in 2021. She was named by Forbes magazine as one of 30 under 30 in finance in 2011 and a rising star by the Women's Forum for Economy and Society in 2012. She's a member of the Economics Club of New York and appears frequently in the news media. She earned both her bachelor's and master's degrees in economics from Boston University. Michelle, welcome to NYU. Our last panelist, and by no means the least, is Torsten Slok, who's the chief economist at Apollo Global Management. Prior to joining Apollo, he worked for 15 years on the sell side, where his team was top ranked by Institutional Investor in Fixed Income and Equities for over 10 years, including the #1 spot in 2019. Previously, he worked at the OECD in the Money and Finance Division and the Structural Policy Analysis Division. And before that, he was at the IMF in the division responsible for writing the World Economic Outlook, as well as the division responsible for China, Hong Kong, and Mongolia. He frequently appears in the media and has published numerous articles and reviews on economics and policy analysis. He studied at the University of Copenhagen and as well as at Princeton University. Again, Torsten, welcome to NYU. With that, I'm going to hand over the floor or the screen to our first panelist, Jan Hatzius, who will now share his screen and give his market outlook. Jan, the floor is yours.
Wonderful to be with you. Thanks so much for having me. And I am going to just summarize our outlook for the global economy with an emphasis on what we see in the United States. We are on the optimistic side of the consensus. We've been in the soft landing camp, kind of post-inflation surge of 2021 and first half of 2022 all along. And the title of my presentation is Soft Landing Summer, because I think a lot of what we've seen, especially over the last few months, is strongly supportive of our soft landing views. Just in terms of where we see global growth, generally above consensus views. That's true in particular for 2024. 2023, of course, is already to a significant degree sort of in the bag. So the forecasts for 2023 are a bit more convergent, but we generally have more upbeat views across most economies than the consensus for 2024. And that's particularly true in the United States, where we're at 1.9% for next year, whereas the consensus is at 0.9%. So a 1 percentage point difference is reasonably sizable as these things go. I think the difference between our view and the consensus is probably even more pronounced if you look not just at the baseline GDP forecast, but also at estimates of the risk of recession over the next 12 months. That is, the probability that the US economy will enter a recession in the next 12 months. The consensus there has been above 50% since late last year. The latest reading, if you just go to a Bloomberg screen and type in ECFC and look in the top right-hand corner, latest reading is 60%. Our view has been below 50% all along, and we've moved it down further from 35% right after the banking turmoil of early March down to 15% at this point. And 15% you should think of as sort of average recession probability. Over the very long term, there's been a recession approximately every 7 years, so 15% is average probability. Now, why do we have a so much more optimistic or maybe less pessimistic forecast than the consensus? I'd say the basic story is that we have seen clear evidence that inflation is moving down to the Fed's target or strongly in the direction of the Fed's target without a substantial deterioration in the real economy. We think the real economy is going to continue to perform reasonably solidly with some ups and downs. The third quarter is probably going to show a very strong growth quarter. We're at a little over 3% quarter-on-quarter annualized for real GDP. The fourth quarter is probably going to be somewhat softer. We're at 1.3%. But on average, over the next 5-6 quarters, we're looking at something on the order of about 2% growth. And there are two drivers of decent growth on the growth side. The first is that real disposable household income continues to grow at a pretty good pace. We are probably going to see real inflation-adjusted disposable personal income grow at about 4% in 2023. And our expectation is that next year is going to be a little softer at about 3%, but still quite a solid growth pace. And we think that even with a gradual increase in the personal saving rate, and we do expect a gradual increase in the personal saving rate from levels that are still pretty low, even with that increase, that should allow personal consumption to grow in the close to 2% range. And there are some potholes. There are some reasons for somewhat weaker growth in the next few months. One particular reason is the restart of student loan payments, which is going to occur at the beginning of October. However, our estimate is that this is going to be a hit of something like $60 or $70 billion. Households, student loan borrowers are going to have to pay $60 or $70 billion more on an annualized basis. That's about 0.3% of disposable income. We think it's probably a hit to consumer spending of about 0.2%. So still a relatively moderate drag and shouldn't really derail the the continued growth in consumption. Second reason why we have a more constructive view on growth is that we think the drag from monetary policy tightening that operates via tighter financial conditions is largely in the past. We look at the way that monetary policy is transmitted to the real economy really through the lens of our financial conditions index. And our financial conditions index tightened quite dramatically in the first half of 2022 as financial markets became effectively accustomed to the idea that the Fed was going to deliver a large amount of monetary tightening. Our FCI tightened by 300, 400 basis points via higher interest rates, weaker stock prices, wider credit spreads, and a stronger dollar. But since the middle or fall of 2022, we've effectively seen financial conditions go sideways. Our financial conditions index effectively hasn't changed since the summer of 2022. And our analysis shows that the impact of financial conditions on real GDP growth really operates via changes in financial conditions with relatively short lags. The maximum impact from a financial conditions shock on growth occurs with approximately a 2-quarter lag. And therefore, as you can see on the right-hand side of this chart, the maximum impact from the tightening of financial conditions in the first half of 2022 occurred in the second half of 2022, with smaller negative effects going through the last several quarters, and most of this hit now in the past. So strong real disposable personal income growth and a diminishing monetary policy drag and financial conditions drag suggests to me that growth is going to continue to be fairly close to the economy's long-term trend, if not even a little bit above the long-term trend. We have the long-term trend at 1.8%. We have actual growth at about that, or maybe a touch stronger. Now, what about inflation? I mean, one big question is, of course, if you don't have a recession, how are you going to bring inflation back to the Fed's target? Well, the good news, and the news really has been very, very good, is that underlying inflation has already fallen dramatically over the past several months. And there are a lot of different measures of inflation. There's the headline CPI and the headline PCE index, which is strongly affected by temporary factors operating through commodity prices. There's the ex-food and energy measures of the CPI and the PCE index, which are also can also be quite affected by outlier moves in a number of special categories. Our favorite measure of underlying inflation really focuses on the underlying trend, the middle, roughly 2/3 of the distribution of monthly price changes as captured in the Cleveland Fed's trimmed mean CPI inflation rate and the Dallas Fed's trimmed mean PCE inflation rate. And as you can see, we have seen a dramatic slowdown in trimmed mean inflation over the past 6 to 12 months. We were running at about 5 to 8% annualized in terms of trimmed mean inflation on a month-on-month annualized basis. In 2022, we've come down to the roughly 2.5% range since then. That's still not quite the 2% official inflation target that the Fed has indicated, but it is quite close, and it's probably in the sort of range that the Federal Reserve would be prepared to tolerate, at least in the medium term or in the shorter term, given that the 2% target really applies to the longer term. So we've already made an enormous amount of progress in terms of disinflation, and I think that is already effectively a proof of concept that we can achieve a large amount of disinflation without a large amount of weakness in the real economy. I think one really key question for future inflation is the balance in the labor market. The labor market overheating of 2022 was almost as much of a concern as the sky-high inflation numbers. So one other big question is, are we able to bring the labor market back into balance? And there the news has been really excellent as well. We have seen a very substantial rebalancing of the labor market. And that rebalancing of the labor market has taken place in a very painless kind of fashion via big declines in job openings with very little increase in the unemployment rate and very little decrease in employment relative to the labor force, which is basically 1 minus the unemployment rate. As you can see here, you can see that their employment as a share of the labor force is basically where it was prior to the pandemic. It has been going roughly sideways for over a year, but job openings, that big surge and really unprecedented surge in job openings has largely unwound, and we're almost back to where we were in February 2020. Other indicators of labor market balance have also improved very substantially. A very popular indicator is the quit rate, the percentage of all employees that leave a job voluntarily in a given month. That surged kind of post-pandemic, rose to 3%, unprecedented number, and it has come back down to 2.3%, which is exactly where we were on the eve of the pandemic. The right-hand chart shows a measure that we've put together at Goldman Sachs, which is simply a word count, and that is based on earnings transcripts in the Russell 3000 that basically count the share of management teams that cite either labor shortages or worker shortages. And that rose dramatically in 2021 and has come back essentially or almost to the levels that prevailed prior to the pandemic. So I think some very, very clear signs that the labor market has largely rebalanced. You can also see that if you look at wage growth as sort of an indicator of how much pressure there is in the labor market. Nominal wages were growing at about 5.5%, averaging across a number of different measures. That's come back down to about 4.5%. Now, 4.5% is still higher than what's probably consistent with 2 or 2.5% inflation over the longer term. If you think about an economy that sees productivity growth of about 1.5%, you want 2 or 2.5% inflation, that gives you a sustainable wage growth rate of about 3.5 to 4. So there's still some work to do. But the good news is that if you look at surveys, somewhat more leading indicators of wage growth, additional improvement, additional deceleration is probably in the pipeline. So also, I think some pretty encouraging news on the wage front. Now, what does all of this mean for monetary policy? Where do we see the Fed going? Our expectation is obviously no hike at the meeting next week. That is pretty much clearly signaled. We also don't have a hike at either the November or December FOMC meeting, although I think there is a possibility that we will get an additional hike, but our baseline is effectively nothing, with the Fed holding the funds rate at the current 5.25% to 5.5% range until the second quarter of 2024, with very gradual cuts thereafter as they try to get back down to something closer to their estimate of the long-term neutral rate, which they currently actually are still put in the 2.5% median. We think that's probably going to drift higher, but we would expect very, very gradual cuts but at a pace that is slower than what is currently priced into the market. probably because most market participants still have a more negative view on the economic outlook than we do. Thank you very much.
Thank you so much, Jan. Our next panelist is Michelle Meyer. Michelle, whenever you're ready, take it away.
Thank you very much. It's great to be here with the NYU community. It's also great to follow Jan, especially when my views largely agree with Jan. So that makes it very convenient to be able to comment after Jan. So always good to agree with Jan Hatzius. So let me start with our big picture view, and then maybe I'll dig into a bit more perspective here. And I'm not going to share slides. I'm just going to stick to some talking points around how we're thinking about the economy, and you can always follow up after with some additional charts. So Jan mentioned this idea of normalization or rebalancing that was in one of his slides, and that's been a critical phrase that I've been using with a lot of our clients to explain what's happening in the economy. Because when you think about the pandemic and this economic cycle, the pandemic created a considerable distortion to the economy. Obviously, it was a huge health event. It was a destabilizing event for the global economy. And it was met by extraordinary monetary and fiscal policy, which created this burst of demand in an environment where supply was quite constrained. And that contributed to the slide that Jan showed in terms of this big run-up of inflation. We're now at a point where we're past that, where supply chain issues have largely been resolved. Costs of production have come down. So the price pressure on companies from higher costs have been reduced, which means that they're not necessarily demanding the same price from consumers. And we think that's been part of what has helped to bring down underlying inflation, particularly in the goods side of the economy, is that you don't have that same degree of supply side pressure that generated quite a lot of inflation. The other dynamic that's really important when it comes to this renormalization or rebalancing the economy is that the demand side has also changed. And the demand side changed because consumers were coming out of the pandemic in 2021 with an exorbitant amount of support to their purchasing power because of stimulus funds, because of the inability to spend on the typical things that they did when they were in the lockdown mode. So you have this burst of demand with a lot of purchasing power with very, very supportive household balance sheets in 2021. And now we're entering a period where consumers are returning to an environment where they're much more dependent on the path of the labor market, on the flow of income creation, where their balance sheet is still important, but they're not sitting on the same degree of excess savings. They're not sitting on the same degree of the potential for debt expansion, because during the pandemic they deleveraged a whole lot. So the consumer now is being a lot more mindful of how they are spending and engaging in the economy. And the reason I bring up the consumer is because at the Mastercard Economics Institute, we are looking at the economy through the lens of the consumer, leveraging a whole lot of data to understand what the consumer is doing in real time. And the consumer, I do think, is taking back some of their power now, where certainly less willing to accept higher prices, much more focused on those promotional periods. And throughout this period of time, if you look, for example, the University of Michigan Consumer Sentiment Survey, we saw expectations for inflation to remain very low, right? We never really had a reset higher of inflation expectations. The sentiment was always for a more low and contained environment over the long run for inflation. So that consumer psychology, I think, is still very much here and is an important contributing factor to what Jan showed in terms of this slowing and underlying inflation that's happening even without the typical labor market push, right? Because the unemployment rate is still very low, wage growth is still very strong, and yet you are seeing that slowing or that disinflation in the economy, which is very, very important and necessary for rebalancing or normalization of the economy. So to me, and the way that we're thinking about the US right now is that we're making great progress towards the rebalancing, that the moderation is here, right? Particularly in the nominal economy. When you think about nominal GDP growth running as strong as it was in 2021 and 2022, that's not sustainable. We're now converging to something that's closer to trend, and that conversion is coming with the slowdown or that move back towards closer to 2% inflation as the target. The real economy, right, when you take out inflation, that's actually been a bit more normal for a while, right? If you think about the real economy last year, you already had close to potential growth rate throughout last year with some volatility on a quarterly basis, mostly due to the inventory cycle and trade, as well as some investment fluctuations. And this year we're running somewhere close, as Jan said, just slightly above or at potential close to 2% for real GDP growth, seeing how Q3 and Q4 ends up shaking out, with Q3 at the moment tracking very strong, Q4 potentially looking a little bit weaker to the extent that you see some of what Jan talked about around payments. So to me, it's an economy that has had a lot of buffers, a lot of shock absorbers to be able to tolerate the inflation that came out of this initial pandemic period where you had the imbalance in the economy. It was an economy that was able to tolerate higher interest rates, right? The Fed has been able to pull off the hiking cycle in a pretty impressive way, bringing interest rates currently to 5.25% to 5.5%. And it did transmit through parts of the economy, right? When you think about the housing market throughout last year, we certainly did see a pullback in home sales. You saw some weakening in home prices in certain markets. Home prices, that said, have remained very, very elevated overall. You did see a transmission to parts of the banking sector, to the flow of credit. So it's moving into the economy. I think it's moving in more slowly than people had feared or expected. And therefore, the underlying economy has been able to tolerate all this incredibly well. So it's not to say that we're not supposed to be on alert. Obviously, we have to look for those risk factors and the concerns that might be out there in terms of the stability of the economy. But at the moment, I think the economy has been on its path towards rebalancing in a very impressive way, with a resilient consumer leading the charge. Two other notes I want to make around a little bit outside of the cyclical economy and more about the structural path forward. So, when the pandemic hit, everybody's trying to figure out what will normal be again, right? How is the economy fundamentally or permanently changed because of this? And there were so many theories thrown out. Nobody knew. We still don't really know. But we can now look back and decipher a few trends that I think have been very interesting. The first one is that there has been a pull forward of the digital economy. There's been a digitalization that I think has been really important, which should be supportive for productivity and greater efficiency. One thing that we see in our insights is that there has been an acceleration to move to spending online across a variety of different categories. That might have happened anyway if given enough time, but the pandemic seemed to pull that forward. And the consumer has stuck with that for many categories, not all, but for many categories. The other interesting thing is how the labor market will evolve. When that pandemic hit, we definitely saw a lot of resignations. We saw displacements in the workforce. There was this buzzword of the Great Resignation, if you recall. And I think that we've definitely been, observing a labor market and a labor force that has been improving, that has picked up. So if you look at the labor force participation rate amongst 25 to 54-year-olds, which the Federal Reserve deems as that cyclical participation rate, it is now above where we were prior to the pandemic, with certain populations significantly above. So the female participation rate of that age group is actually at a record high. And you can potentially attribute part of that to a more hybrid workforce, maybe, right? Better matching in the labor market, maybe more efficiency, better choice of where employees get their jobs and where employees find their workers, because you expand the pool of workers in a more hybrid workforce. So, there's a lot of debate over hybrid or in-person, remote, et cetera. So I don't think that that's been answered yet by any means, but I do think that some of the changes that the structure of the workforce has likely contributed to a rebound in participation that has exceeded expectations. And that's a nice positive for the durability of this business cycle as well. Still a lot of questions out there around mobility, about travel. We've seen lots of movement of people throughout the US as a result of the pandemic. We'll see how that continues to play out. Obviously, very critical to continue to have momentum in the global economy is that movement of goods and services. So a lot going on. I think maybe in the interest of time, I'll stop there. I'll just reiterate this point. around a normalization or rebalancing of the economy. I think that's critical to how we're thinking about the economy. And I think it's a good way of shaping the discussion that we'll have today. So back over to you.
Great. Thank you so much, Michelle. Our last panelist is Torsten Slok. Torsten, whenever you're ready, you can share your screen and take it away.
Thank you so much. Yeah, so when we look at the outlook, we are a bit more worried about the downside risks for a number of different reasons. And the first way to think about what's going on, where is the economy right now, is to probably take a look at, well, what is the Fed's own answer to where the economy is right now? And if you compare the GDP nowcast for the third quarter of this year from the Atlanta Fed with the same forecast from the New York Fed, with the same forecast from the St. Louis Fed, it doesn't really help too much. Atlanta Fed is estimating that GDP in this quarter will be 5.6%. The New York Fed just started publishing last week their nowcast, and that's saying that GDP growth this quarter will be 2.25%. And finally, the St. Louis Fed is actually saying that we are already in a recession. So when you think about the Fed being data dependent, then you do wonder a little bit which of these three measures should I be looking at? Is it the data from the St. Louis Fed, which tells me that the Fed should actually be cutting rates very soon? Or is it the data from the Atlanta Fed that's saying that maybe the Fed should actually be hiking rates a lot more? So from that perspective, any discussion of data dependency and any discussion of where are we right now is particularly challenging by, in this case, the fact also that the Fed and the system itself is also having quite a differentiated view depending on which Fed institution and which regional Fed you look at. The list of things that we worry about the downside, and Jan and Michelle talked about several of these, but let me just try to summarize this in a complete way. As we all know, a very important theme in financial markets has been that households are running out of excess savings. There's a number of different estimates. The San Francisco Fed just put out a piece where they came to the conclusion that U.S. households are running out of excess savings here in the third quarter, meaning this quarter. And that's, of course, implying that all the excess money that has been spent, in particular on consumer services, is no longer going to be available looking ahead. Most importantly, coming out of the pandemic, everyone wanted to travel, go fly on airplanes, stay at hotels, eat at restaurants, go to sporting events, concerts. All the things that we didn't do during the pandemic have had a significant tailwind because of the excess savings in the household sector. The issue now is that the excess savings running out, in particular for some income categories, is already showing up in a number of areas, in particular in delinquency rates for consumers beginning to move higher for certain segments of consumers. So the bottom line first is that households running out of excess savings is playing a very critical role. The second thing, as also we just talked about, is that student loan repayments are coming back. That's an important debate about, it may be starting the 1st of October, but if the envelopes have already started to arrive, maybe consumers are smoothing it out, and maybe therefore we will already begin to see the data in retail sales spending and consumer spending more broadly start to slow down over the coming months. Delinquency rates are rising for credit cards and auto loans. In my view, this is not only about the change in interest rates. If the logic here is that we give a shock to interest rates where the Fed funds rate goes up from 0 to 5.5, it must also matter what the level of interest rates is. It cannot only be the change in interest rates that matters. In other words, if it really were only the change, the Fed could raise the Fed funds rate to 20% tomorrow, and we would, in that case, stay at 20%. And if we were staying at 20%, it would obviously, in my view, begin to have some very negative consequences. So the discussion, I think here, and we can debate this during our discussion in a minute, really is that it is not, in my view, only about the change in interest rates and the change in financial conditions. It is also about the level that matters, which is exactly what we're seeing in delinquency rates at the moment. And more importantly, in credit, we're beginning to see quite a significant move higher in default rates for high yield and for loans. And why is that the case? Well, think about it. Every day when you read the Financial Times and the Wall Street Journal, there are companies who cannot get a new loan. There are companies who cannot roll over an existing loan. In other words, monetary policy is working exactly as it was intended. It's biting harder and harder and harder on corporates simply because They financed themselves very cheaply during the pandemic. And now the level of the cost of capital has gone up so much that this is now beginning to have every single day implications for corporate spending and, of course, also for consumer spending. So I'll show you the charts in a minute. But the result of that is, of course, that when you lift the Fed funds rate permanently to a higher level, it will have a permanent hard shock on consumers and on corporates. We're also beginning to see that on interest coverage ratios, they are falling both for IG and high yield. And remember, interest coverage ratios measures what are earnings divided by interest expenses, interest costs and interest expenses. And the conclusion, of course, there is that we have seen a significant increase in interest expenses also for investment grade companies. And that's why you have started to see in credit a fairly rapid decline in interest coverage ratios. You're also seeing the banking sector is stepping fairly hard on the brakes, both when it comes to small banks, but also when it comes to large banks. I can show that chart if anyone is interested in doing the discussion. But the conclusion is the banking sector, in particular since March, has been stepping fairly hard on the brakes, and that is now beginning to have more and more serious consequences. Again, in particular, in terms of new lending to consumers and new lending to corporates. Finally, oil prices are going up. We have slowing growth in China, Japan, and Europe, and we should certainly also discuss that. We have long-term interest rates going up for what I would call non-economic reasons. Long rates at the moment are not going up because the economic data is getting better. Now, long rates are going up for a long list of other reasons that are driving the term premium higher. For example, we are still doing QT. We just had a sovereign downgrade of the US. We still have that there's a significant issue about Japan exiting yield curve control, which is still having some risks that Japanese investors are now looking at their own backyard and seeing higher yields and therefore likely selling US treasuries and taking therefore money home. And that's also putting upward pressure on US rates. Finally, we're also seeing that during the debt ceiling debacle here in June, the Treasury started issuing a lot more T-bills. So that meant that the weighted average maturity of debt outstanding in the US started going down. And now the Treasury Borrowing Advisory Committee just decided in July that a lot of that snowball of T-bills that we have in front of us needs to be extended in duration so that we can get the average maturity of debt outstanding up again. And the consequence of that is also that over the next several months, we'll see auction sizes continue to move up. Auction sizes for 10-year, 30-year, 7-5-year will go up on average 25%. This is also putting already upward pressure on the long end of the curve and the belly of the curve. So the risk is that we have the economics and the slowdown likely pulling rates lower in our view, but at the same time, we have a long list of non-economic reasons for why there's going to be some upward pressure on rates. And we're seeing at the moment rates continue to tick higher, and that is indeed having a fairly significant impact. And therefore, interest rates are again from this front biting harder and harder. And finally, higher interest payments for the US government is, of course, also playing a very critical role. That debt servicing costs have gone up from an average during the pandemic. This was around $1 billion in interest payments by the US government every single day. And now the CBO estimates that this has gone up to double that amount, maybe about $2 billion every single day. So the conclusion is, taking all these 10 risks together, the near-term outlook is unfortunately still that we are about to see some more downside risk to growth. And let's just spend a minute on thinking about the transmission mechanism of how does monetary policy actually work? What happens when the Fed is raising rates? And the best and simplest way to think about this is to think about this through what happens to firms and what happens to households. And what you see in these two bars here is credit quality. For firms, of course, we have a credit rating. Some firms have a AAA rating. Other firms have a CCC rating. For households, we have a FICO score. Some households have a FICO score that's above 800. Others have a FICO score that's at 300. When the Fed starts to raise rates, what happens is that those that are first impacted are households and firms with more debt, lower earnings, and lower savings. So that happens to be lower, in this case, weaker balance sheets, and therefore lower credit ratings and lower FICO scores. But think about it, as interest rates continue to go higher and stay at high levels, we begin to go up in terms of who's impacted in terms of credit quality. So over time, more and more balance sheets will be negatively impacted by Fed hikes. And that's exactly what we're seeing if you look at the economic data we've been getting since the Fed started raising rates. So this is CapEx spending. So think of this as corporate spending, of course, on equipment, structures, software. When the Fed started raising rates, CapEx spending started slowing down, and that process continues as the Fed keeps rates at these levels. Likewise, employment also has been slowing down. When the Fed started raising rates, employment growth was around 600,000. Fast forward 12 months, employment growth was around 400,000. And the latest employment report we got showed, of course, that employment is now growing at only 187,000. So it makes complete sense that the consensus is coming to the conclusion that we will continue to see this process of monetary policy biting harder and harder on consumers and biting harder and harder on corporates. So let me just end with a few pictures showing that process playing out in the data. This is delinquency rates in credit cards. Look at what's happening with delinquency rates for people who are in their 20s and their 30s. Despite that we have the strongest labor market at the moment, literally in 50 years, meaning the unemployment rate is near the lowest rate that we've seen in 5 decades, people are still falling behind on their credit card payments. And who is it that's falling behind? These are households with generally lower savings, lower incomes, lower FICO scores. So this is a precursor, of course, for what will happen to the rest of the credit spectrum. In other words, if I go back to this chart I had here earlier, we are beginning to bite harder and harder and harder, where the macro data is exactly responding as you would expect, namely by weakening gradually over time, simply by employment growth slowing gradually. So in my view, it would almost be a miracle if this starts moving sideways from here. Instead, we should expect that this continues to move lower. And in fact, the consensus is telling you that in 6 months' time, we will have employment growth that is close to zero. So you start wondering how the S&P 500 and credit spreads will be trading if we do get that non-farm payrolls in the first quarter of next year is going to come in at almost zero for 3 months in a row. And this is also playing out elsewhere. This is credit card delinquency rates. You're also seeing that younger households, and here younger, I deliberately means people in their 20s, 30s, and 40s are beginning to fall behind. I mean, look at people in their 30s. Despite the labor market supposedly being very strong, we have levels of delinquencies that are higher than we had in 2020. And finally, the same thing is also happening when you look at corporates. This is in the blue line, the default rate for high yield. And think about it. When the Fed started raising rates over here, of course, in March of last year, default rates, there were companies that couldn't even deal with the initial rate hike and therefore went under. But look at what has happened to the default rate over the last 6 months. It has really gone up very quickly. The pushback I sometimes get from clients when I talk about this, that people say, oh, these are just companies no one's heard about. Well, why is this happening? This is happening because the Fed has raised rates and we're going to stay at these levels for probably another year, at least according to current pricing and Fed fund futures. The risk is, of course, that this will continue to mean that every single day there are companies, in particular in tech and growth and venture capital, who cannot get financing and therefore will throw in the towel, and therefore the delinquency rate, and in this case for consumers, and in this case the default rate for companies is going to grind higher. So if I just put in the dotted line here and think about where might this be by the end of the year, we think the Fed will definitely not cut rates by the end of this year. We will get a default rate that's at 6%. We are approaching levels that are similar to what, of course, we have seen during previous peaks. We're not expecting definitely anything remotely close to what we saw in 2008. But the bottom line in our view is that a number of the things that you would expect to happen if the Fed hike rates is exactly happening. So another way of saying this is, let me just summarize all this by saying that if you think about what is it that the Fed is trying to achieve by raising interest rates, they want us to buy fewer cars. They want us to buy fewer homes. They want us to spend less money on our credit cards. They want companies to spend less money on CapEx. They want companies to hire fewer people. And that's exactly what's happening. And that's exactly why we should expect that process to continue. And therefore, in my view, the risk is that there's more downside as a result taken together of a lot of these risks at the moment playing out exactly as the textbook would have predicted, namely because of the Fed hiking rates and trying to slow the economy down. So with that, Venky, let me stop there and turn it back to you.
Thank you so much. So now we're going to switch to the Q&A portion of the event. I want to thank all our panelists for a wonderful kind of intro. I'm going to try and curate the questions. I'll try and kind of select themes and present them to the three panelists. I apologize if I can't ask your question in exactly the way you worded it. I'm going to try and make the best use of their time. So let me pick up on one theme that I see in a bunch of these, a number of these questions, and that has to do with geopolitical considerations, right? And this has obviously a very, several dimensions, whether it's the ongoing conflict in Ukraine, whether it is, the risk posed by China or by some developments in oil and commodity markets. So a number of the questions have asked you to weigh in on how geopolitical considerations and geopolitical risks have either shaped your outlook or would affect your outlook. And again, we'll stick to the same order. Jan, you go first, followed by Michelle, and then Torsten.
I would say geopolitics is obviously not my main area of expertise. That's the first thing to say. Second thing is that the most obvious way in which geopolitics affects, say, the US or European economic outlook is via commodity prices and commodity shocks. That was very much in evidence, of course, in February 2022, when you had a massive spike in energy prices, oil and in particular natural gas. So, yeah, to the extent that we have a lot more geopolitical conflict, especially if it's in an oil-producing region. Russia, Eastern Europe is sort of one example. The Middle East is obviously another example that would, tend to push commodity prices higher and increase inflation, and probably at the margin have a negative impact on economic activity in a lot of the advanced world. Less so in the US than in Europe, because the US is a much bigger energy producer. So the direct effect of higher energy prices on economic activity in the US, I think, is more muted. It is probably negative because the household sector, which tends to lose from this sort of thing, has a higher marginal propensity to spend than the corporate sector, which in aggregate benefits. But it probably, so it would be a negative. I don't think it would necessarily be a huge negative. It would boost headline inflation, no question. But I would emphasize again that the key thing to focus on from an interest rate perspective and from the perspective of whether we're able to achieve a soft landing defined as a decline in underlying inflation to more acceptable levels without a big downturn in the economy, that really depends much less on headline inflation than on something like the trimmed mean measures that I showed.
I mean, I think Jan touched on it with commodity prices. There's not much left to say on that front. I guess another mechanism would be just a heightened degree of uncertainty. So when you have big geopolitical events, it tends to lead to uncertainty, which could impact the corporate sector in terms of their investments, more so than the consumer. But so you can see, if there were to be some sort of major geopolitical threat, companies might postpone some major investments, whether that's capital investments or labor market expansion, investing in their workforce. And that could have additional dampening effect in the real economy, and something we do see and have seen in the past when we've had these types of global events. And then I would also argue that the flow of credit is important too, right? You kind of have the bleeding of global risks or geopolitical concerns into the economy, into the US economy through the financial system, through access to credit and the price of credit. So that would be another channel that I would pay attention to. But I think the primary one, and the one that would matter most for consumers, would be the inflationary dynamic through particularly what consumers pay at the pump. That's the most meaningful to the average person out there. So Torsten, over to you.
Yeah, no, not much to add to that. I mean, the only, if geopolitical also here means the outlook for China, of course, one worry is that with China slowing, that has some negative implications for Europe. And the implication of that for the US is still relatively limited. But the main problem at the moment is that we worry a bit that Chinese growth is slowing, not only for cyclical reasons, meaning exports in China at the moment are falling 15% because Europe is slowing and the US is also gradually slowing. But China is also slowing for two other reasons, namely because of demographics and also because of some of the challenges in the housing market and associated challenges in the trust system and in the banking sector. So the conclusion from that is still that global growth outside of the US is trending lower. And that is not a dramatic negative impact on the US outlook, but it's enough to still make us a bit worried about what the implications are for US exports. And the final point, and everything, of course, Jan and Michelle say here, I agree with that. It's all about commodity prices. The little bit special thing is that OPEC is now cutting back production, so oil prices have actually gone up quite a bit, which is not helping the Fed, because that means inflation is about to go up again, including in the number that we'll get tomorrow. But it also has some implications for thinking about that. Is it really so obvious that commodity prices are going to go down just because global growth is slowing, in particular in an environment where energy, which makes up the vast majority of the commodity complex, but where energy is actually going up because of production costs from OPEC. So there's a number of different nuances in that important discussion. But very broadly speaking, I think we all agree that that's from a growth perspective, the US consumer is not really dramatically impacted in any significant way by those developments.
Great. But that's a perfect kind of segue to another question. This is from Dick Berner, which has to do with what you just touched upon, Torsten, which is slowing growth in China. And I was hoping to, for all three of you to weigh in on with your views on that, both from a perspective because China being a big part of the global economy, what's happening in China is of independent interest, and second, to the extent that that's going to have spillover effects on the US economy. Again, Jan, Michelle, and Torsten in that order.
I'm happy to do that. We can also mix it up a little bit more because I know it's always more difficult to go second or third, but I will take this one and then maybe we can reverse the order or mix up the order in the future. Our expectation on China is decelerating growth, potential growth. I mean, part of that is simply that China has been a very poor country, is a less poor country now. They've had a lot of opportunities for productivity growth by just moving to best practice in a lot of industries. They have had, sizable increases in the working age population. Both of those factors are turning more negative. Productivity growth is probably going to slow, and the demographic impact is certainly turning more negative. China last year saw a decline in the population for the first time since the late 1950s. The birth rate has come down pretty dramatically, still seems to be falling. So the projections for China as far as demographics are concerned are quite weak. So the supply side is definitely slowing, and there are some important demand side factors that are probably also going to be a drag on growth. And I'm thinking specifically of the very overextended housing market, very high level of housing activity. It's been falling, but there's probably still more room for housing activity to fall. Vacancies are already very high. There are, obviously negative effects on the financial system from the weakness in the housing market. So you can certainly tell a story in which Chinese growth becomes much less strong, much less exceptional than it has been, and China becomes part of the kind of slow growing world economy over the next several years. And that's even before you get to significant further deterioration in the US-China relationship. Those are additional risks. But even if you just focus on some of the economic fundamentals, I think there is a good case to be made that China will see a substantial amount of slowdown. Now, in the shorter term, as Torsten said, the cyclical data have been quite soft as well. So there are clearly some challenges. The government did put out a 5% growth target for 2023. And as the data have disappointed, they have, put in somewhat more stimulus. I think they will continue to do that if the data stays soft. Ultimately, I think they probably achieve 5% or a little over 5% growth in the near term. So I don't see as much weakness, as much downside in the near term, but I think there are some clear long-term challenges.
I would just add one additional perspective in terms of what China means for the rest of the world, particularly the US and Europe. When you think about this time last year, the consensus view out there was that we would see this resurgence of activity coming out of China, that Europe would be in a recession, the US would be in a recession. consensus economists, we don't all get it right? So that clearly did not happen. But what is, I think, very important is that despite having much softer than anticipated growth out of China, we still managed to see a European economy that exceeded expectations, and certainly a US economy that significantly defied expectations and grew well above the views heading into the year. So while the global economy is heavily linked, while there's quite a lot of importance between what's happening in the US, what's happening in China from a trading perspective, from an overall global growth perspective, I think it is pretty remarkable and important to remember that in a year where China came in weaker than anticipated, the developed economies came in stronger than anticipated.
So I don't really have much to add. I agree with everything Jan and Michelle said here.
Great. So the next question, and I think this we'll do this in reverse order. I'll tell you why we do this in reverse order in a second. A few questions. There have been more than a few questions on the risks of vulnerabilities in the financial system, both perhaps in the US and perhaps more even beyond the US. Like earlier this year during Silicon Valley Bank, that this was a big discussion, and this was viewed as a big headwind for growth and where policy is headed. So I leave that. I give you. I mean, you guys can answer this question at whatever level of detail you deem fit. Some of this has to do with issues in the commercial real estate sector. Some of this has to do with rising delinquencies that Torsten pointed out. So the question is, how do you see the financial system shaping up over the rest of the tightening cycle? With banks still seeing deposit outflows. So there seems to be a lot of headwinds. How is that feeding into your outlook, and what kind of risks do you see from the financial system? So we'll start with, we'll go in reverse order, Torsten, Michelle, and hopefully we'll end on a positive note with Jan.
Okay, so let me share my screen just to answer that question. So this chart here shows you assets in the US banking sector ranked by size. So JP Morgan makes up 15% of all assets in the banking sector. If you add JP Morgan and Bank of America, those two banks combined make up 26% of the assets in the banking sector. So now you go fast forward to First Republic and Silicon Valley Bank. Obviously, they no longer exist. But what's noteworthy here is that the banks to the left, which is 60% of assets in the banking sector, they are generally in good shape. But the risk, of course, is that the banks to the right, in particular, given that they are facing a number of issues now with more issues about that they're held to maturity and available for sale books, at least under some pressure because rates continue to move up. That was the fundamental problem, of course, for Silicon Valley Bank. The second thing is that they've, of course, also faced some more issues about the duration of their deposits and the liabilities side of the balance sheet. In other words, if there certainly were questions about what happens with the deposit base, and it suddenly could move around much more quickly, maybe banks to the right in particular look differently at their deposits relative to what they did before March. And the third and final issue is issues about what regulation do we have coming, which also might create some issues about how these banks to the right, and here we're talking about 40% of the banking sector are thinking about the outlook. So therefore, it's not a surprise that since Silicon Valley Bank went under, you've seen loan growth completely at a standstill. This is comparing loan growth for 2022 to 2023. And as you can see, the behavioral change is just really spectacular. This is also showing up when you look at the weekly data from the Fed's H8. This is loans and leases and bank credit. So there's a different way of saying lending to consumers, to corporates, to real estate, commercial real estate, residential real estate. And look at the loan growth in small banks relative to the loan growth in large banks. So the Fed started raising rates. And immediately the large banks said, if the Fed is raising rates, that has implications for credit quality. That has implications for how we think about our balance sheet. So maybe we should begin to slow down our loan growth. And that's what the blue line and the big banks have been doing. But the small banks, it didn't impact them at all. The Fed started raising rates and they continued to grow their lending. It grew at 15% and it was literally the highest level ever. It was only Silicon Valley Bank that made them change behavior. And now you're seeing the small banks are slamming on the brakes and the large banks are also slamming on the brakes. Note that it's not the case that the large banks are stepping in and stealing business from the small banks. No, everyone is slowing their lending growth. And if you put down some very embarrassingly simple dotted lines here on where might this be over the next several months, you ask the question, okay, but if loan growth is slowing fairly quickly, well, the implications for macro of what happened in March, of course, are very significant, because this does mean that the banking sector, and again, just to repeat, here we're talking about 40% of assets in the banking sector that are now reorganizing their balance sheets because of these implications. And the challenge, therefore, is that we still have a quite significant pressure on the banking sector, and in particular the smaller banks, but the banking sector more broadly. At least it's very clear that they have changed their behavior quite dramatically after Silicon Valley Bank. So the conclusion is that we absolutely do not expect any financial accident really anywhere in the US financial system. Everyone across the board still has quite strong balance sheets, but the behavioral change that we have seen and the implications for the business cycle is very serious, as these charts here are suggesting. So if someone is looking for financial stability risks, then I don't see any financial stability risks. But I do worry quite a bit about what the cyclical risks are for the business cycle.
It's hard to follow that one, especially all those charts. But I would echo the point that Torsten made around the stability of the financial system and the stability of household balance sheets and even corporate balance sheets. So we're in a healthier place, certainly. And, you know, if you think about the post-financial crisis period, the post-08 period, and even after the pandemic as well, you know, the banking sector operated with pretty tight lending standards overall. We never saw a period really of excess in terms of lending standards or borrowing. But that, so I agree with Torsten in that those financial stability risks, or the systemic risk, is probably pretty low. But credit is the oil for the economic engine. So following the path of credit, the flow of loan growth is going to be important. Those dotted lines in Torsten's chart were particularly problematic, but those dotted lines are not happening now, right? So where we're running right now is somewhere between 5 and 10% loan growth, which is actually strong relative to a normal expansion. So we'll see where it goes. We do have to monitor it. That's part of the transmission of monetary policy. That's part of this environment of higher borrowing costs. And as part of the thesis that I had talked about before with this rebalancing or normalization in the economy, moving towards a more trend-like, slower, but trend-like growth rate in the economy, particularly on the nominal side.
I view it as more of a rebalancing as well. I mean, clearly things are significantly weaker than they were in 2021, when you had 2021, 2022, when many economic indicators were at really unsustainable levels and certainly unsustainable growth rates. And you know, the Fed has been tightening monetary policy, as you say. I mean, I think as we've all said, part of the transmission to the real economy is by persuading banks to lend less, and we've clearly seen that. There was an added, period of weakness, kind of post Silicon Valley Bank. We actually had a short period of outright declines in seasonally adjusted loan balances in the weekly data. Now, and we had a tightening in availability of credit for small businesses. You know, not a huge one, but there was a deterioration. What I see, though, in the most recent numbers is actually a little bit of stabilization. So the loan numbers have again picked up a little bit to positive growth rates, low positive growth rates. And the National Federation of Independent Business, I think, has a very useful series, namely the share of small business borrowers that found credit harder to get than 3 months earlier. We just got the latest number this morning, and that balance came down from 6% to 4% net, on 4% of firms finding credit harder to get. So that's still a pretty muted and incrementally slightly less negative reading than what we had in the prior couple of months. So far, I would say what we're seeing here is a modest drag, but nothing that I'm too worried about.
Great. So the next question, and this touches on a couple of questions in the Q&A box, has to do with bond and equity prices. So I know that's not necessarily what your forecasts are about, but I think that's a topic of great interest to a lot of members in the audience. So obviously this year has been a great, we've seen a great run up in equity prices. At the same time, the bond market is pricing in, kind of at least substantially higher real rates than perhaps we've been used to for some time. And so there does seem to be, on the face of it, something of a disconnect in U.S. equity and bond markets. And I think I was hoping to have you guys comment on that. Again, we can go Torsten, Michelle, or really let's go Michelle first and then Torsten and Jan this time. And again, you could turn this into a more broader comment on your outlook for markets in the U.S. Take it away, Michelle.
This will bring me back to my Wall Street days, which weren't that far away. But now at Mastercard, less focused on talking to the investor community and more talking to the business community. So I guess my outsider perspective would be that, generally speaking, the fixed income community is looking for what might go wrong, right? There's generally an overwhelming concern around the downside risks. And I think that has been the case for some time with this inverted yield curve. So there's been a discomfort with how rapidly the Fed has hiked, a view in the bond market that the economy can't handle this level of interest rates. And that has been part of what spurred this inversion of the yield curve. But I think when you look at rates, and I think particularly when you try to tie it to the economy, it's important not just to look at nominal rates, but real rates. And when you look at rates in real terms, it's actually been still a fairly accommodative environment because interest rates were rising to fight high inflation. And we're only now at a point where we're starting to see a bit more constriction in terms of real rates. So that will be interesting to see how that plays out in the future and how the Federal Reserve handicaps that, because if they keep monetary policy as is and they don't start to cut nominal rates with inflation coming down, they're going to be unintentionally tightening with higher real rates. But I think this inversion of the yield curve really came from this discomfort that bond markets had around the ability of the economy to handle high interest rates. The view that, we're going to be at zero for long periods of time, that you can't really ever get that far from zero, the lower bound. And we've managed to get very far, and the economy has managed to be much more resilient. Where equity markets and equity investors have tended to look a lot more at fundamentals, looking at what the companies are reporting, looking at what you're seeing for pricing power, and more focused on the nominal economy, right, in terms of overall spending and overall economic expansion. And there's been a positive story, particularly this year, relative to expectations, where you've seen a consumer who's been able and willing to spend, and companies that have been willing and able to expand in their workforce and elsewhere. And I think that's being reflected in the equity market. So at some point there'll be a convergence, right? We'll see market participants kind of come together when the economic trajectory becomes more clear cut. But I think that's a big part of that type of disconnect. So when you think about where we go from here, I think the bond market very much is, again, tied to the path of monetary policy. If we're close to that peak in monetary policy, then we're probably close to peaks in yields as well. And that seems to be, again, priced into markets pretty appropriately.
No, I would agree with all that. The Fed is probably close to the peak in hiking. We can discuss if they will hike again in November or not, but most likely, in my view, not. And if they keep rates at these levels and monetary policy ultimately begins to work as it should by slowing the economic data down, then the implication is that then long rates should be moving lower. So from that perspective, the duration today looks very attractive. The only issue now is that if that slowdown comes with a faster slowdown than what we all would like to see, then the implication, of course, is that that also comes with more risk of credit spreads widening, in particular on high yield and loans, and for that matter, even on IG. So that's also why if the process that we're going through is that things are slowing, and if that's what we all expect to continue, and the only thing we're really debating is the speed of that slowing, I still think that risky assets, including S&P 500, in particular NASDAQ and venture capital and growth and tech, is very vulnerable because rates are going to stay high and earnings are going to slow down. And that cocktail of high risk-free rates is page 1 in your finance textbook, and slowing earnings is not good in particular for companies with high leverage, low interest coverage ratio, and poor credit metrics more generally. So the broad view that I have at the moment is that short rates are going to stay higher. One should be up in quality in IG, in credit. One should be staying in the front end and betting on, in particular, 0 to 3 year rates staying at elevated levels. And then I worry about long rates moving down, and I worry about credit spreads widening, in particular for lower rated credit. And I also worry about especially more vulnerable names in tech and growth and venture capital, and therefore more broadly in NASDAQ being more vulnerable. But also I see downside even to the S&P 500.
As you'd expect, I think the differences in economic outlooks are going to translate into some differences in the views on, the major asset markets. Our forecast for the funds rate is a bit higher than what's priced in the markets. So, I think rates are likely to stay pretty high, at the shorter end and at the longer end of the yield curve. I do think that the economic environment, if we continue to get broadly sort of soft landing news, that should be generally positive for equity markets, though I think gains are likely to be muted in an environment where rates stay high. I mean, that has been, I think, the main sort of roadblock for the equity market making additional gains in the last 6 weeks or so. We had obviously quite strong performance until the sometime in the summer. We've had a pretty sizable backup in interest rates, despite, or maybe because of, pretty friendly economic data. And I think that challenge, we might continue to see that challenge. So if I look to our strategists, their expectations are effectively no change in equity prices in the US through the end of the year, and then relatively subdued gains in 2024. So 4,500 or so by the end of this year, 4,800 around the end of 2024.
Wonderful. So one question, a couple of questions touched on a theme of a somewhat longer or a more medium-term kind of outlook for the U.S. Over the last few years, we've seen a lot of changes, some good, some perhaps not so great. We've seen, AI technologies kind of emerge as a significantly or as a potentially transformative kind of technology. We've seen the U.S. government increase its shall we say, both spending and perhaps almost industrial policy-like initiatives with the infrastructure bill, with the CHIPS Act, and a whole number of initiatives. So how do you, what are your, I was hoping you could take a couple of minutes to talk about your kind of more medium-term forecast for the U.S. growth picture. You could make it about the global economic picture if you like, but I thought the questions I see in the box are more about the U.S. outlook and how these kind of changes have perhaps changed your thinking on that. Let's go maybe the same order, Michelle, Torsten, yeah.
Sure. So prior to the pandemic, there was an overwhelming consensus that we were seeing a continuation of slowing trend growth, that demographics are unfavorable, aging population, that globalization was either reversing or not going to accelerate, and that we were not on the cusp of any major technological change that was going to be a game changer for the economy. So the general belief was that the moderation in trend growth that has seemed to occur over the last decade would continue to some extent going forward. I think that view has been challenged now. We haven't fought aging. We still have the same unfavorable demographics. But we have changed, I think, two other things: the structure of our workforce and our embrace of technology, in part because of the pandemic. So as I noted in my initial comments, one of the nice surprises to many folks out there has been this re-engagement in the workforce. The fact that the prime working age participation rate has increased decently above 2019 levels for certain cohorts. And that could continue. I don't know that that's over yet. I think that there's better matching in the workforce. And I think that there's opportunities for more engagement in the workforce. So that is the positive for overall trend growth, and it fights against demographics. And by the way, on the demographics front too, yes, the pandemic created earlier retirements for a lot of folks, but now we're starting to see some people who had retired come back into the workforce, right? So the idea that people, as they age, they can work longer, they can continue to be productive longer once some of the health concerns have passed. So both of those, I think, are generally supportive for participation rates and could fight against otherwise these demographic challenges that, again, are here. We have lower fertility rates and we have an aging population. And then the technological advancements, generative AI, et cetera, we'll see how that all shakes out. It could be a displacement of some of the workforce, which would be an issue. But it also could very much lead to some pretty significant gains in productivity and efficiency. So all else equal, I think relative to prior to the pandemic, I would be more positive on those trend growth estimates, at least over the next decade or so.
Just to add to that, I mean, thinking about it from a production function perspective, I mean, labor is obviously, as Michelle is saying, something that traditionally has not been contributing much. The good news for the US is that it's much better than the rest of the world, Japan in particular, but also Europe. So from that perspective, it is probably still a down arrow when it comes to potential growth. But for a number of different reasons, including immigration, it looks a lot better than what we have elsewhere. Think about capital. As you're highlighting, the Inflation Reduction Act, the CHIPS Act, we will certainly get a lot more capital investment, and all that capex, in particular in manufacturing facilities, is certainly also something that potentially could be an up arrow and something that could be changing things. And finally, think about total factor productivity. I mean, the real challenge is that I don't know in my DSGE model or in my FERPIS simulations, I just don't know how to put AI in. Yes, I do think that it will have very significant implications. But it's just really difficult to quantify at this point. I just don't quite see what the transmission mechanism is. I completely get if you simulate that total factor productivity is a lot higher, of course, it will do wonders to growth. But that's like saying that if you have higher productivity, you will also have higher growth. But convincing me that that link is there and that total factor productivity will be a lot higher because of AI is still unclear, but I do understand that this is something that has the potential to change a lot of things in many different directions, both to the upside and also to the downside.
Clearly, this is where it gets really uncertain. I mean, we've been talking about, predictions for the future, which are always very uncertain. But if you're looking at what the impact of AI is going to be on productivity and on long-term growth, that's much more uncertain, in part because I think it's pretty clear that in the near term, 2023, 2024, the impact is probably going to be very small. It will take several years before a significant impact can really occur. With all those caveats, I think there is potential for a pretty sizable impact on productivity growth. And I think the reason is not that it seems likely, from my sort of non-technologist perspective, that we're going to be introducing artificial general intelligence anytime soon, some super-powered, AI that will be truly creative. That doesn't seem, that seems even further away than the sort of timeframes that I just talked about. The reason is more that it seems by looking at the occupational kind of classifications and occupational data from the US government or European governments, that there's quite a lot of low-hanging fruit in advanced economies, basically low-level and mid-level kind of administrative work and desk work that could be replaced by AI to a pretty significant degree. And we've done a fair amount of work on trying to quantify some of these numbers, as you'd expect. You get a very large range of potential outcomes, but our central estimate is something on the order of a 1.5 percentage point boost to annual labor productivity growth over perhaps a 10-year period, starting maybe 5 years down the road And I realized that's a very, very large number, and it's too uncertain and a little too dramatic for me to really build that into any of my sort of baseline forecasts. But it would be consistent with or similar to the sort of productivity boosts that we've gotten in past technological revolutions, the personal computer and the internet, or electricity. So I think there is a real potential for seeing a very sizable impact, but I think time will tell, and we'll probably have that discussion still for a number of years before we really know whether we really are getting a big impact or it turns into much more of a muted nothing burger, so to speak.
Wonderful. Thank you so much. Again, I want to kind of end with one, question that's unrelated to economics and markets. There are a lot of students in the audience, and to all of them, you're wonderful role models. You've all built successful careers. You've spent several years in the private sector in various roles, and some of you in the public sector, in the public sphere. So I wanted each of you to take maybe 30 seconds or a minute, for a few words of advice. What's the secret sauce that goes into this, or what advice would you have for the students in the audience today?
Yeah, we may be competing to go last.
Okay, so that's it. You spoke up first, so you go first, Torsten.
Okay,
and then Michelle, and then Jan.
It's really hard. I mean, I don't think there's a Coca-Cola recipe. You need to think that this is all interesting. Jan and Michelle and I, we are really good friends. We meet all the time. We met for 15 years now, and even before, when I was in the public sector, I also spoke to both Michelle and Jan, and we constantly debate and discuss and think about things, and we are really good friends, and we still sit here, and there are some nuances in how we think about things. That doesn't really mean anything other than it's an interesting. This is like going to an academic seminar in NYU. You hear a paper, someone says, okay, I think this is the right way of doing things. Well, I think this is another way of doing things. And there's no right or wrong. And as we know, we have all been impressively wrong in our careers. We've been impressively right in our careers. We try to do our best jobs of serving our constituents or our clients and giving the best advice. But what I would say is, at least from the broadest perspective, is that it's about having some structured framework for what are we talking about. You could ask me, is the stock market going up? And I could say yes. Next question. But that's not really interesting. You would be much more interested in understanding, why do you think that's happening? So it's really about having some structured thinking. What are the bullet points? What is your framework? What are the models you're using? What are the different variants of looking at the world? And what is the right way of trying to put together that story and trying to put together that view of, do we think ultimately that in our 3-hour cases that the Fed will be raising rates or lowering rates, or what they will be doing? And this is really difficult. There's so many things. Unfortunately, there is no simple OLS regression you can run, and here is the answer. So it just requires a lot of structured thinking, a lot of frameworks where you end up saying, what are the bullet points on the scale? What argues for this? What argues for that? And how do I put weight on these different arguments? And we, as you can hear here, we have a little bit different weight on different things, but at the end of the day, we're really talking about the same things, but from slightly different angles. Maybe that doesn't really answer the question, but at least a framework and some education and knowing what you're talking about is absolutely key.
I think that does answer it. I would also just add in 2 additional things. The first one is, wherever you end up finding yourself in your career, it is really important to have passion about the work that you're doing, to really love it, to enjoy it, to be part of it, to be excited to go to work every day, to be excited to challenge yourself. And if you get to the point where that no longer is occurring, then you pivot. You change, you realize that your career is a marathon, that there's many different twists and turns that are okay. And I think always trying to find that new challenge and not being complacent is important too, which in the economics community is very simple to do, to find those new challenges, because the economy is always shifting. So our job naturally as economists, I consider us to be very, very lucky, because the environment, the world is changing all the time. So our job is naturally changing. I've never found myself bored, and I still don't find myself bored. And I still find myself to be very passionate about the work that I'm doing. So I think that is really important. The other one I think is essential is to spend a lot of time thinking about how to communicate and how you want to kind of define your own brand. And this has become increasingly important in this day and age where people don't have necessarily the same patience as they did in the past, right? There's so much information out there. There's so much sound bites. There's an assortment of ways to get data and to get information. So be able to find a way to contribute to that in a way that could be compelling or interesting. So one example is what Torsten does that has always been very compelling, this idea of sending out one chart every day with a soundbite, with a few blurbs. That's really impactful. It's easy to read. It's enjoyable to look at a chart, and clearly has been a huge point of your success. So I now receive your emails, and I love them, and I look forward to that. And in my job now, as I've been designing content, it's much more about interactive charts and using technology to enable views and using data to tell your story as well. New data, different data. So I think those potentially could be some helpful guidelines as well.
Yeah, I think the less is more point is a great one. I totally agree with that. We all have a tendency to feel like we are producing a lot and we're adding a lot of value if we produce a lot of stuff. Right. And we have a lot of exhibits in our pieces and we really go deep. But the key is really to be incremental because there is so much information out there, and really think about the things that you can do that are really different and that will really resonate, and keep the other stuff a little bit briefer. I often tell my colleagues and my younger teammates who are just sort of starting out that a pretty good chart is the mortal enemy of a great chart, because you have like a bunch of pretty good charts and then it's actually pretty difficult to find the great charts. The one other thing I would say, and I'm conscious that a lot of this depends on exactly where you end up, but just from the perspective of a forecaster who is trying to make predictions about the future, don't be afraid of putting yourself out there and disagreeing with the consensus. It, of course, is going to mean that you're going to be wrong some of the time, but it's not the worst thing in the world to be wrong, as long as you are receptive to new information. And if you've taken an out of consensus view that hasn't worked out, you pivot and you say that you're making a change. People don't hold that against you. They know that it's very difficult to make out of consensus views, forecasts about something as uncertain as the economy or the capital markets. But what people are looking for is a framework and a distinctive view. And if you have the analysis to back it up, go with where your analysis leads you, and don't be afraid to disagree with people. But I would completely agree that it's very important to not be disagreeable. And I think hopefully we've managed to not be disagreeable despite some differences in view today.
Wonderful. That's a great way to end this, and thank you so much. I want to thank on behalf of everybody at NYU and everybody on this call. I want to thank our distinguished panelists. It was fantastic, extremely educational. We'll have lots to think about and chew on. And for all of you who attended, once again, thank you for attending the event, and I hope to see you all at future events. With that, I'm going to close this call, close the webinar. Thanks again, everyone.